$2,800 a month in dividend income sounds like it takes a six-figure lump sum to build. It doesn't. It takes $4 a day, 5 holdings, and enough time to let them do their jobs, but only if every holding is doing a different one. In this video, I'm going to walk you through how Josh builds a simple 5-holding retirement portfolio from scratch: 1 ETF, 1 REIT, and 3 dividend stocks. He runs it across 3 timelines: 10, 20, and 30 years, based on how much time you have left before retirement. And by the end, I'll show you how just $4 a day into this portfolio could build Josh over a $500,000 portfolio that pays him over $2,800 a month, and how he could reach the same goal 20 years faster. But that portfolio only works if you understand the gap it's designed to fill. Let me show you what I mean. The average Social Security check for retired workers is $2,076 a month. The average retirement costs somewhere between $4,800 and $5,000 a month. That's housing, food, healthcare, transportation. No luxury, just living. The gap between what Social Security pays and what retirement actually costs is roughly $2,800 every single month. That's the gap, and that's the number this entire portfolio is built to fill. Most people's savings can't touch it. The median retirement savings for American households is $87,000. At a standard 4% withdrawal rate, that generates roughly $290 a month. Add Social Security, and you're still more than $2,400 short. And that's assuming the market cooperates, no early withdrawals, and the timeline holds exactly as planned. Timelines don't always hold. In 2008, the S&P 500 dropped 57% from peak to trough, and retirees drawing down their portfolios had no choice but to sell into that collapse. Meanwhile, inflation has averaged 2.68% a year since 1989, which means the income that feels comfortable at 65 feels tight at 75 and genuinely difficult at 85. A sell-down strategy doesn't survive either one. A fixed income stream doesn't grow. The bills do. So the goal isn't a bigger savings account. It's building a portfolio that generates enough dividend income to fill that $2,800 gap on its own, and one that keeps growing every year so inflation never catches it. That's what Josh sets out to build in this video, and it starts with one decision most investors never make: choosing 5 holdings that don't all do the same thing. The usual approach looks something like this: find one fund that feels safe, then another one like it, then a third that pays a little more but tracks the same market. Before long, the whole portfolio is built from holdings that look different on paper but move together every single time the market shifts. That works fine until it doesn't, because when everything in your portfolio is built the same way, it all reacts the same way. One bad earnings season, one rate hike, one sector downturn, and the income stream that was supposed to carry you through retirement takes a hit across the board, all at once. Josh isn't building that portfolio. He's building one where every holding has a different job, draws income from a different part of the economy, and responds differently when markets get uncomfortable. One holding anchors everything. 1 pulls income from real estate rather than the stock market. 3 create a floor built from industries that don't move together. Something is always working, even when something else isn't. The question is how you find holdings that actually fit together that way. That's where the criteria come in. Josh isn't picking funds based on what's trending. He's working from a specific set of rules, the same rules every holding had to pass before it earned a spot. The first is dividend yield. Not the highest yield available, the right yield. The sweet spot sits between 2% and 5%, high enough to generate real income from day one, low enough that the company isn't stretching beyond what it actually earns to pay it. Anything pushing past 6% warrants a hard look at whether that payout can survive a downturn. Because a dividend that gets cut is worse than a lower dividend that holds. But yield today only tells half the story. What matters more is how fast that yield is growing. A holding growing its dividend at 10% or more annually doubles its payout roughly every 7 years. That's what keeps income ahead of inflation without the investor doing anything differently. The yield today is almost irrelevant compared to what the yield becomes in year 10, year 20, year 30. Third is share price appreciation. Income alone isn't enough. If the portfolio isn't growing in value, the dividend base stops expanding the moment contributions stop. Holdings that pay well but never appreciate are slowly shrinking in real terms. Fourth is sector diversification. No 2 holdings from the same industry. When healthcare struggles, consumer staples often hold. When REITs compress under rising rates, dividend ETFs stabilize. One sector having a bad year doesn't take the whole portfolio down with it. Fifth is cost and accessibility. Low expense ratio, liquid, available on any major brokerage. No complex structures, no lockup periods, nothing that requires specialist access to explain. No holding hits every criterion perfectly. Some carry a lower yield justified by stronger appreciation. Some have more modest appreciation justified by a dividend growth rate that more than compensates over time. The criteria don't find perfect holdings. They find holdings whose trade-offs make sense given what everything else in the portfolio is already doing. Josh looks at everything the criteria produced and starts grouping. Some holdings are built to grow, some are built to pay, some are built to hold steady when everything else doesn't. And the more he looks at it, the more he realizes no two holdings in this portfolio should be doing the same job. That's where the three jobs come from. The first job is the foundation, one holding that drives the entire portfolio forward. Broad market exposure, consistent dividend growth, steady appreciation that compounds over decades. It doesn't need to do one thing exceptionally well. It needs to do everything well enough that the other four can specialize. The second job is the income layer, one holding that pulls cash flow from a completely different part of the economy. Not the stock market, real estate. When equities struggle, real estate income doesn't necessarily follow. That separation gives the portfolio two distinct engines running at the same time, drawing from different sources, paying into the same account. The third job is the floor, three holdings from three different industries, each one built to hold income steady through the cycles that hurt the others. Consumer staples hold when healthcare pulls back. Healthcare holds when consumer brands take a hit. Together, they create a base that no single sector downturn can knock out entirely. One foundation, one income layer, one floor. That's the architecture Josh is building, and every holding from here fits into one of those three roles before it fits anywhere else. In just a few minutes, I'll show you how Josh's 5-holding portfolio could turn $4 a day into a $500,000 portfolio that pays over $2,800 a month. And by the end, I'll show you how he could reach the same goal 20 years faster. But first, let's look at the 5 holdings. Josh starts with the foundation. And the perfect stock for this role is SCHD, the Schwab US Dividend Equity ETF. This is where 40 cents of every dollar goes. SCHD tracks an index of high-quality U.S. dividend payers, companies that have been growing their payouts consistently for years, screened for financial strength and sustainability. It's the holding that does everything at once, grows, pays, and doesn't require watching. The yield sits at 3.46%. The 10-year dividend growth CAGR is 10.43%, and annual share price appreciation averages 8.76%. That combination of income, growth, and appreciation is why it anchors the portfolio at 40%. The trade-off is straightforward. SCHD alone doesn't get Josh to over $2,800 a month. That's not a flaw in the fund. That's the gap the other 4 are here to fill. The first holding to help fill it is PepsiCo with the ticker symbol PEP. Josh already knows this name. He just never thought of it as a retirement holding. That's exactly why it works. PepsiCo's job in this portfolio is stability. People buy food and drinks regardless of what the market is doing, which means PepsiCo keeps collecting revenue and paying dividends through conditions that would slow down a growth-focused holding. The yield is 3.77%. The 10-year dividend growth CAGR is 7.31%, and annual appreciation averages 4.28%. That appreciation is the lowest in the portfolio and worth addressing directly. PEP isn't here to grow fast. It's here to hold the floor when everything else moves. Lower ceiling, stronger floor, and in a retirement portfolio, that trade is worth making. But a floor built from one industry isn't a floor, it's a bet. That's where Merck comes in. MRK sits in healthcare, and healthcare and consumer staples don't move together. When inflation squeezes consumer spending and brands feel the pressure, healthcare demand doesn't slow down. People still fill prescriptions. Merck's job is to hold income through exactly those cycles. The yield is 2.86%, the lowest of the 3 dividend stocks, but the 10-year dividend growth CAGR is 6.7%, and annual appreciation averages 9.06%, the highest of the 3 protectors. The lower yield is the trade-off. The appreciation rate is what justifies it. Together, MRK and PEP create a floor built from 2 industries that rarely struggle at the same time. Then the portfolio steps outside the stock market entirely. Prologis, ticker PLD, is a REIT, a real estate investment trust, and its job is to generate income from a completely different economic engine. Prologis owns and operates warehouses and logistics real estate across the country, the physical infrastructure behind every online order placed and filled. When someone clicks buy, there's a Prologis building somewhere in that supply chain, and by law, REITs distribute at least 90% of their taxable income to shareholders, which means Prologis is structured to pay. It comes with a yield of 3.3%. The 10-year dividend growth CAGR is 10.01%, and annual appreciation averages 9.4%. The honest trade-off with any REIT is interest rate sensitivity. When rates rise, REIT valuations can compress even when the underlying business is performing well. The rest of this portfolio isn't rate sensitive in the same way, which is exactly why PLD belongs here. It adds an income layer the other four can't provide. And the final stock on Josh's list is the Federal Agricultural Mortgage Corporation, with ticker symbol AGM. That's not what anyone expects to find in a retirement portfolio, and that reaction is worth sitting with for a moment, because it's the same reaction most investors have before they look at the numbers. AGM is a government-sponsored enterprise that provides liquidity to agricultural and rural lenders across the United States. It's been doing it for decades, operating in a corner of the financial market that most retail investors never think about. AGM carries a 4.4% yield. The 10-year dividend growth CAGR is 23.48%, more than double anything else in this portfolio. Annual appreciation averages 12.77%. That dividend growth rate isn't a typo. It reflects a business with pricing power, consistent demand, and a structure that keeps generating income regardless of what technology stocks or consumer brands are doing in a given quarter. The trade-off is that AGM is smaller, less widely covered, and carries more concentration risk than any other holding in the five. That's the limitation. But no other holding in this portfolio can replicate what that 23.48% dividend growth rate does to the income stream over 30 years. That's why it's here. Put all five together, and the portfolio blends out to a 3.53% dividend yield, an 11.3% 10-year dividend growth CAGR, and 8.83% average annual share price appreciation. And that dividend growth rate is what does the real work over time. Those are the blended numbers, but numbers on paper don't pay rent. What matters is what they actually produce when Josh puts money behind them, and that depends entirely on what he starts and how much he's already working with. Same five holdings, same weights, 3 different starting points. If you have 30 years before retirement, time does most of the work. Josh starts from zero. No lump sum, no head start, just $4 a day into the 5 holdings, reinvesting every dividend along the way. By the end of year 1, Josh would have invested around $1,460. By year 10, it is projected to grow to $26,805. Compounding does its work slowly in the early years. By year 20, the balance is projected to reach $126,586, and the dividend income is building real momentum. Then the final decade happens. The portfolio would more than quadruple from year 20 to year 30, because an 11.3% dividend growth rate running uninterrupted for 2 decades doesn't add linearly, it compounds. By year 30, the balance would reach $554,395, paying $34,145 in annual dividends. That's $2,845 every single month, from $4 a day, over a $500,000 portfolio built from nothing but consistency and time. If you have 20 years before retirement, time alone isn't enough. You need a head start. If you look at the 30-year timeline, most of the growth came in the last decade, which means if you only have 20 years, $4 a day isn't going to get there. You're missing the decade that does the heavy lifting. To reach the same target in less time, you have to give it a better starting push. To retire in 20 years from now, Josh starts with $20,000 already invested and commits to $15 a day. Based on this investment commitment, the projections show that after year 1, the portfolio would be valued at $27,948, already generating $707 in dividends. By year 10, the balance is projected to reach $167,116. The final decade does the same compounding work, but from a significantly higher base. By year 20, the portfolio would reach $718,869, paying $34,994 in annual dividends. That's $2,916 every single month. The head start doesn't just save time. It buys the compounding momentum that the 30-year path got for free. If retirement is 10 years away, there's no time for compounding to build slowly. The portfolio needs a real foundation from day one. For this one, Josh starts with $225,000 already invested and adds $20 a day, $7,300 a year. The portfolio would open year 1 at $260,119, already generating $7,950 in dividends annually. The compounding curve is steeper from the start because the base is larger. By year 5, the balance is projected to reach $453,183, generating $15,407 in dividends annually, $1,284 a month. By year 10, the balance would reach $883,248, the largest ending balance of the 3 paths, paying $34,037 in annual dividends. That's $2,836 every single month, right at the target. The 30-year path needs the least money but the most patience. The 10-year path needs the most money but delivers the largest balance. More time means less money up front. Less time means more. All 3 paths land within the range of the same $2,800 target. The only variable is when the decision gets made. If you want to see how Josh takes $35 a week and puts it into Vanguard index funds, all the way to $8,000 a month, that video is on screen right now.